now I want to talk about the competitive landscape. It was largely with you coming in, it became a three-horse race at this point in time, but you've now got the incumbents moving into the quick commerce space. I mean, Big Basket, for instance, now moving full tilt into quick commerce. How is the competitive landscape changing? How do you create moats around you? How different is the Zepto customer, for instance, from a Blinkit customer today?
Yeah. Look, I think at the end of the day, this game is about execution. If we execute well, I think we'll build a very large outcome. If our competitors execute well, I think they'll build a very large outcome. I think competition is probably the difference between, again, just hypothetical numbers, between like, 50 billion and $60 billion outcome, that's competition, that's market share. But from 5 to 50 billion, that's execution. And so, we think we're genuinely lucky to have quality consumer internet players that are our competitors that help us be a better company. We learn from them. Hopefully they learn from us. We think if we just put our heads down, execute well, we'll build a large outcome. So far, that's been true. I mean, I think when we started this company early to mid 2021, mid 21 to early 2022, that was the most intense competitive period. And candidly, that was when we were the most vulnerable because we had the least amount of capital. We were an upstart. You had all these large established startups that had already gotten into play, right? But our philosophy then, and as our philosophy is now, is listen, just be heads down, execute well. The outcome will be good if you do that. And
do you feel less of an upstart today?
No, I think it's a good question, but I think right now we're still operating like a 0 to 1 startup. What I tell the Zepto team every day is that we have not made it, right? Like we are not a $5 billion company. We are a $50 billion company in the making if we don't mess it up. That's a simple thought process.
And that's what I want to talk to you about. And this takes me back to a conversation that I was having with Sameer Nigam at PhonePe, and he was talking about building and execution and scale, and the silly stuff, in his words, that sometimes we've seen people do. What is the silly stuff that you are mindful of, that you are avoiding or you have managed to avoid? Yeah. And what's the non-negotiables that has to be done?
100%. And Shereen, I think the silly stuff is essentially allocating capital in low ROI or zero ROI ways, right? Essentially, my job is like an investor, I'm a capital allocator, right? And so my job is to, allocate capital to wherever I see, rigorous paybacks and ROI. And let's say, you launch like 500 markets randomly, right? And like 300 of them are unviable, right? And that's just like capital wasted. There's zero ROI in that capital. Or for example, if you like launch a new business, hastily, you end up sort of blowing up that capital, right? Or if you just go, give 100% of your customer base just like crazy discounts, all that is just like wasted capital because you're not going to get ROI on that over the long term, compounding ROI. I think we've been able to successfully, historically avoid that, which is why if you look at the outputs, with a fraction of the capital that all the other renditions of consumer internet the decade prior, whether it's ride sharing, food delivery, e-commerce, all those other renditions of consumer internet, we've gotten to a scale with a fraction of the capital that they took. And so in I'd argue more capital intensive space. So you can see that rigor in execution there because we've spent a very small amount of capital to get to the scale that we're at. If I benchmark, let's say e-commerce, or if I benchmark, let's say ride sharing or food delivery, they were multiple times more capital to get to where we are today. So we feel good about that. I think we have to keep holding on to that now that we've got more capital. If you ask me today, do we have a plan to invest all this capital in a high ROI way? The answer is no. And even if I have, XXX cash in bank, I would not deploy a dollar if I didn't, in good faith, believe for our shareholders that it would be high ROI. And today we don't have a billion of investment plan, unfortunately or fortunately.
Yeah. Well, so take me through from a high ROI perspective, as you just pointed out, the priorities for this year, perhaps over the next 2 years. I mean, what is going to be prioritized? Where will you deploy capital? So how will you deploy capital?
Look, I think it's two major buckets of investments, right? I mean, the way that we look at it is firstly we have a 10x customer experience across like speed, quality, selection, and price. And we are working on all of them, without going into too many details for obvious reasons, but we've got a lot of work we're pushing on the customer side. That's priority number one of the company. The second priority is how do we build leverage, right? Execution-led leverage, whether that's variable costs improving, whether it's advertising income going down or going up, whether it's CAC efficiency and excellence on customer acquisition, whether it's new categories that are giving us average order value growth, whether it's the scale and sourcing leverage that we'll be able to unlock on the back end, right? All of that we're working on the leverage side, and there's much more beyond that. And then the third bucket for us is investments, right? And the buckets for investments for us today are, let's say, 3 broad buckets. One would be, for example, new stores. Very simple. There's a.
So what's going to be the store count at the end of FY25?
So we think we'll be at least 700 stores by March 2025. That's what we put out there. We think we can do a little bit more, but right now, again, we want to be prudent, right? So we're going to go for 700 by March 2025. If you look at, but could be more, but as we speak, that's the plan. And then obviously, we want to invest in, new customer acquisition efficiently. And again, we're looking at the paybacks of all the acquisition that we're doing. And then we also want to invest in new capabilities, right? So, for example, new capabilities like, building out a full-fledged software stack for advertising, right? That is a meaningful, engineering task that, a lot of our peers candidly have already done over the past decade, right? And we are building it from scratch today. And we have to put together the team, the resources, we have to give them capital. And so, that, for example, investing in that R&D and that software build-up is meaningful. So those are the 3 buckets of investment. These are the 3 things that we want to do: customer, leverage, and investments.
Let me pick up on the advertising side, because I think when we last spoke, you talked about the fact that the aspiration was to take that number from ad income to about 1,000 crore rupees. On track?
Yes.
Yeah,
we're on track. Absolute terms, although I think it could be going faster, and this team is watching, so I think it has to be going faster. But I think, less than 12 months, it'll be over 1,000 crores very realistically. Right now, we will start run rating. Already 600, close to 600-ish.
You talked about customer acquisition as well. How sticky is the Zepto customer? I'm a one app person, so but I imagine the ecosystem that you operate in is not like that. How sticky is the Zepto customer, and what do you do to ensure repeat transactions?
No, for sure. Look, I think the retention is fairly high. It's meaningfully higher than, say, food delivery and ride sharing, and the overall baseline over 6-9 months. So I'd say, look, customers are not particularly loyal at scale. And there's no real loyalty. It's about who gives the best customer experience on the field on that day. If you consistently get a bad experience on, let's say, X player, you move to Zepto. The vice versa is also true. If you have consistently bad experience in Zepto, you move to the other player. Which is why we just focus on our customer experience metrics. And historically, we had to take very tough calls. We were sitting in 2020 to 2023 candidly on the verge of death, right? Capital was not capital efficiency was not like an intellectual a goal. It was like a life or death constraint. And so we had to really constrain ourselves, and there was lots of things that we had to do just to keep customer experience at a decent place while we could capitalize the company. And we did that. And I think now, we are really investing in customer experience.
You talked about pricing and the leverage on pricing, but how much pricing power do you have today, and do you believe that you're going to be able to continue to enjoy that, given the fact that it's a fairly competitive space and you're going to have more competition coming in? How do you ensure pricing power? Because then that brings up the profitability question and whether this is eventually going to work or not.
Yeah, look, I think it's pretty clear it's working, right? You've got in 2.5 years, essentially a couple of months ago, we went from 0 to well over $1 billion in scale, and we got close to EBITDA break even at a company level. There's forget about internet company, there'd be probably 0, large scale, profitable companies, even the settled industries that would have had that scale and profitability curve that quickly. So I think, profitability is not really a question, it's more about execution. I think if you look at all our competitors today, the way that we look at it is, all our pricing power, and you mentioned, let's say, discounts and unfair discounts, etc. All of it is coming from structural leverage, right? Today, if I'm pricing, a product X, firstly, our partners take those calls, based on what they see their margin to be, but they're not taking calls that are just, hey, let's just burn money, right? Everyone today, if you look at, the partners that are running the stores, so 70% of them are profitable, and they're operating at a decent level of price. Then it's structural in a way, right? It's structural efficiency that's driving that. So we don't believe in equity capital to fund a customer experience metric, right? That's highly unsustainable, and that's, I think, the mistake of the last decade of consumer internet.
That's what I was going to ask you. Would you call that the big mistake of the previous decade?
I absolutely agree. Because it's not sustainable, and I tell you, to give you a sense, right? It is actually the worst allocation of capital that you can make. If you today start saying, I'm going to put equity capital towards pricing unstructurally, right? And I'm going to, give my partners the ability to do whatever they want, and we're going to give them no constraints. Everybody is crazy. Who cares about the P&L? That actually is not going to give you. Forget about, you're going to get a pop in GMV, but the second you pull that, it will go back down, and you're not even going to get long-term compounding market share. So if today, some competitor comes in and just starts randomly, discounting, which, has happened historically in the past without naming names, then we think it's like a death knell. Like that's a
no go. How IPO ready do you feel today? And what are going to be the next sort of pieces that you focus on before you actually get ready to file the DRHP?
Yeah, so I think we've been lucky to have like an exceptional CFO and finance team, and I think we were joking with the team the other day. I don't think that there's a company with such a short life cycle that's completed like such a rigorous financial due diligence for this round. We did like a very rigorous financial due diligence that I think candidly probably did not happen pre-2021 in the internet ecosystem.
And was that because of the expected IPO?
Yeah, no, it was just because like in general the ecosystem is now a lot more wary about these things, right? And it's a large amount of capital. People want to do their due diligence, which we encourage, right, as a company. Like that's great. I honestly think it's just like a matter of when do we see the right sweet spot of, hey, we're inflecting. We think that we're going to get into harvest significant amounts of free cash flow in like a relatively short period of time. That's I think the right spot to go public. And look, it's a commercial strategic call.
Yeah.
I think that happens in probably sooner than even I anticipated.
Yeah.
And we're a fast company, so we take a call to go public. We go public very quickly, but yeah, I mean, I think 2026, potentially even late 2025 is a realistic timeline, and our focus would be build excellence on controls and make sure that you have a high. It's not about profitability today.
Yeah.
It's about do you have, because break-even-ish is not what people are betting on. They're betting on, can you generate 300, 400, 500 million dollars of free cash flow in like a reasonable period of time. And so once we see that inflection point, we'll say.
But does it make it harder to build trust? And I'm not talking about work, but I'm talking about personally, socially. Does it make it harder for a young person like you?
Look, I think the good news is that I barely have a social life. I can say the same thing.
Is that by choice?
Zepto. I'm married to Zepto, right? That's the thinking. And now I'm in the office.
Do you want to continue that way?
Yeah, I do. In the office we're building in Bangalore, I'm gonna just live in the office, like without exaggeration. Get a bed there. Life is going to be good.
So no work-life balance for you, huh?
No, not for us. I mean, we love what we're doing. Like it doesn't feel like, it feels like life, right? This, I feel like I am Zepto in a way, right? But yeah, no. So I think socially, I don't really have a good answer to that question because I've not really gotten there in this phase of life. But personally, I don't think really much has changed. My family still treats me the same way that I am. If my room is a mess, they still give me shit for it and all of that. So it's still the same.
Have things changed in the way that investors interact with you, for instance, or just public perception in general? Because people forget you are 21. I mean, has that changed on the back of what you've been able to do with Zepto? I mean, 2 years ago when you walked into a room versus today walking into a room, how does that feel for you?
I think the benefit of being in Mumbai is that nobody really cares about startups here, like as much as they do.
Which is why you're going to Bangalore.
Yeah. Unfortunately, but we love Bangalore. But it's Mumbai really humbles you because everybody only here cares about cricket and Bollywood and politics, right? Nobody really cares about internet. But you go to third wave in Bangalore, KV gets a lot of attention in a third wave cafe in Bangalore, right? So it's no, I think honestly speaking, it hasn't changed much.
So let me end by asking you, is there a whiteboard in the office somewhere where there is a line that encapsulates the ambition, the dream that you have for Zepto? What does it say?
There is. I have two whiteboards in my office. No, it's like I mentioned, we just want to, the ambition is we want to build something crazy for customers and we want to build a truly exceptional internet company in India. And I know I keep saying that again and again, but trust me, Shereen, if we do it, if a few other companies do it, it's going to be awesome. It'll be a Flipkart moment all over again in the internet ecosystem. And this time, much higher quality companies will get built. And that's what we want to do. So that's written in my room. I have a little note in my room which says, don't mess it up.
Don't mess it up. Aadit Palicha, it's been an absolute pleasure. Thanks so much. Congratulations. We wish you all the very best of luck, and thanks very much for speaking to us today. Well, that's it then on this special edition of Young Turks. From all of us here on the team, goodbye. Thanks for watching. Do stay tuned. There's a lot more coming up on CNBC-TV18.